But, very interesting conversation coming up. My colleague Mangalam had an exclusive chat with the Avenue Supermarts CEO Neville Noronha, someone who rarely speaks and someone whose voice needs to be heard more often. But now we have Mangalam standing by the wall with a few big takeaways from that conversation. Over to you, Mangalam.
Well, how I wish this was a video interview that we had, but you take what you get with the likes of Neville Noronha, rare voice, but extremely important as well, especially with the kind of success that D-Mart has seen in the retail space itself. The last conversation that we had was about 6 years ago. In the middle of that, there was a pandemic, a big surge that we saw in digital as well. So with all these things, the big obvious question was, what are the structural changes that have taken place in the modern retail world in the last 6 years? And to that, he had to say quick commerce could have had huge scale and digitally enabled micro enterprises which can reach small, tiny audiences at very low cost. And that has been the big takeaway over the last 6 years, the big structural change. One of the obvious questions also was that, the mix of D-Mart's sales actually deteriorated largely because perhaps, there have been entries of a lot of these value retailers in the apparel space as well. To that, he said, yes, there is marginal impact and specific to a certain category such as apparel itself. And that's something that we've seen in the numbers of Zudio, etc. as well. But a lot on the street were also worried about why D-Mart isn't growing stores as fast as the street is expecting. On that, his assessment is that the external world is tracking how many more stores D-Mart is adding every year, whereas they worry about how well the stores being added are being actually managed. And that's the big dissonance. But having said that, they would like to add as many stores as possible, as fast as possible. But for that, is there any real estate available to do that? He said, well, that is a challenge, but digital commerce is definitely showing the way. It's quite clear what they cannot do fast, digital can. So that's something that they'll be speaking about. In fact, quick commerce, as per him, is a significantly smarter format for than digital marketplaces and a lot more relevant for India, which is known for leapfrogging beyond different things as well. And on competition and of course digital commerce, he says that digital commerce is indeed the next big challenge for all of us. And while they will be able to compete, the sudden disruption of general trade needs to be keenly watched. In fact, there will be significantly more digital plays before modern trade evolves and matures. And as a result of it, moats of every business will be slightly weaker than pre-digital times. Entry barriers have reduced for most retail businesses, and that could actually reduce profit pools as well. But talking about growth in the tier 2 and beyond, Bharat as we call, he said that this is a multi-decadal expansion opportunity. And lastly, asked him about what his key objectives for D-Mart are, and he said adding new stores and looking for moats in the e-commerce space, and growing that will remain the key focus for the company.
Okay, very, very interesting takeaways, not just for the D-Mart business, but overall for the sector, right? Thank you so much, Mangalam, for putting that into perspective for us. Abneesh Roy is joining in to talk about that. Abneesh, what really stood out for me is the fact that Neville talking about how quick commerce, I mean, it's not going unnoticed anywhere, right? Quick commerce can have huge scale and digitally enabled micro enterprises can reach their small, tiny audiences at very low cost. So here is a large player talking about, large established player talking about the growth potential in quick commerce. What would your takeaway be from that? And from a listed space point of view, where do you see potential now?
Yeah, thanks. Definitely, D-Mart clearly is a gold standard in that space. And we have also seen in quick commerce clearly Zomato through the Blinkit and then Zepto and Swiggy, etc. do really well. For FMCG companies, for example, e-commerce is broadly 6 to 10% of the sales already, clearly taking share both from general trade and modern trade. And within quick commerce, within that, quick commerce is already around 30% of the e-commerce. So clearly growing much faster. Second is clearly now customer is also paying for the convenience. We have seen the ticket size, etc. increase. There is a more rational competition rather than just promotion. So it's a healthy mix of convenience and pricing. So yes, I would say that D-Mart Ready is a play by Avenue Supermart in that space, and they have been doing good work there. So there is a potential now because the competitive intensity from Zeptos of the world or from Blinkits is more rational. I think Avenue Supermart could also scale that up. But on the physical retailing, clearly Avenue Supermart has a huge runway still left. So I would say it will be still dominated by that. But yes, quick commerce could be an interesting option. E-commerce could be an interesting option long term for all these players.
Okay, e-commerce could be an interesting option long term. But what about the Avenue Supermarts share price? Post this interview, I mean, I don't know if you went through the whole thing, but it seems like, very optimistic views coming in on the kind of opportunity size that this space has, given that we're now moving from a low income to a middle income economy in India. For a long-term investor, does it make sense to still buy into this stock?
Absolutely. This is a compounding machine. It went through its own challenges last 1-2 years because of very high competition. And there were investor concerns that the pace of the expansion in terms of the number of stores is also not meeting up. If you see first 3 quarters, number of stores were quite low. But in Q4, they added huge number of stores. So we would say that adding of stores is always bunched up. It is generally slow in the first 3 quarters. That should not be the yardstick to measure D-Mart. D-Mart is extremely well-run company, and they have mastered that model of owning the real estate space, which helps them in passing on the discounts and best pricing to the customer because they don't have the rentals. So yes, I would say 2 states are dominating. So Maharashtra and Gujarat are still bulk of the stores, but in rest of the 26 states, some states they don't have a presence. In most of the other states, the runway is very high. So yes, it's a compounding machine. When we speak to the FMCG companies, they speak very highly. For example, Godrej Consumer, interesting data point. In the Raymond acquisition, they have done exceedingly well in D-Mart stores because both have worked with each other. So what we see is FMCG companies launching specific packs for D-Mart because of the kind of footfalls D-Mart is able to guarantee, plus definitely the pricing barrier which it is there. So yes, it's a good compounding machine. Valuations is always expensive, but I would say the worst is behind in terms of the margins, in terms of the store addition, and on the discounting from the quick commerce also more rational.
Absolutely. And quick commerce, right? I mean, we spoke about the potential there, and the management also talking about the huge growth in quick commerce. Just wanted your thoughts on how to approach a stock like Zomato now, because obviously we're seeing the kind of growth that Blinkit is delivering and everybody's talking about that. But and now with the Swiggy IPO as well all set to take place, do you think this pie is only going to grow further? And hence, apart from stocks like D-Mart, do you think stocks like Zomato continue to be a buy?
So I will not comment on Zomato specific because there is another analyst for this. But yes, 2-3 things clearly favoring the overall space if I see. One is, of course, now we are seeing players go to more cities, go for more rational discounting, which was not the case earlier when discounting was very high. Convenience fee was not there. Now a lot of convenience fee is there. And clearly the quick commerce players also expanding the portfolio of products. So a lot of things going right, and FMCG companies and a lot of the other categories also are very, very strongly focusing on this. Recently, we saw Titan, for example, sell Big Basket, and Titan had this tie-up of gold coins, etc. So categories are opening up. So yes, the space should do well. It's more rational competition, more number of cities getting added, and customer clearly is also now starting to pay for the convenience. So all the things are positive, I'd say.
Okay, all right. Abneesh, more questions, but we're out of time, so we'll have you back soon again.